Hey kids, how are you today? Let me adjust this here. We're going to start off with this thing called the Great Depression. The Great Depression was triggered by what you see here, the Great Stock Crash of 1929. But let's back up just a little bit and talk about what was the 20s and what was it like in the 20s. So here we have in the 1920s this cycle of prosperity we talked about last week. You had the producers making profits and making money. The producer then with that money wants to make more stuff so he can make more money. All right. To make more stuff, though, he has to hire workers. Workers then get paid at the end of the week. They bring their money home and then they use that money to go and buy stuff, whether it's basic stuff like food or some, fun stuff like buying a new car, or buying a refrigerator, or going on vacation. But the consumer then has more money. But the more the consumer spends on stuff, the producer then makes that profit. The producer is going to then want to make more stuff. And around this thing went. Around and around. Here we are. Around and around it went as the cycle of prosperity really made the good times and the money pile up for the American consumer. Now, what that consumer also did, besides buy stuff, however, was they would buy stocks. They'd buy a stock or a little piece of a company. We're going to explain what this is because they assume when they gave the company money for the stock, the company would use this money to grow. Really, all companies are supposed to grow. However, as you may or may not know, the stock market crashed in 1929 and a lot of people lost a lot of money. Here, what you have here is a chart that shows the value of the stock market, which is like saying the value of the U.S. economy, going up, up, up for almost 10 years, a little more than 10 years, actually. But then here it finally crashes, and then back down it comes. The 1930s, really up into the beginning of the World War II in 1941, we experienced this era called the Great Depression. All right, so let's explain. You're going to buy stocks this week. And then I'm gonna back up a little bit here and explain why people buy stocks, and then you're gonna go ahead and buy them yourselves. So a stock is like a little piece of a company. Now, people buy stocks and companies because they expect that company to grow. All companies are supposed to grow, whether it's Apple, who has great growth, whether it has Tesla, who has great growth, or Google, who has great growth over the last 10 years or so. It could be a small mom and pop company. It could be a lawn care company. It could be an independent deli. But all companies are expected to grow. All right? So if all companies are expected to grow, you're going to be a company owner someday. How do you grow? Well, this is how you grow. The way you grow is through increasing in three particular ways. First, you're going to increase perhaps the number of factories. Here's Ford here. Ford had one factory, then he had two factories, then he had four factories. He grew by building more factories to make more cars. But that can be more delis, that can be more clients, that can be more offices. It's just increasing the places where people produce their work. All right. The second thing is going to be they're going to increase production from those places. Yesterday, Ford's factory may be making 1 car an hour, but he's going to increase to 2 cars an hour. And then in the future, sometime tomorrow, he's going to hopefully make 4 cars an hour. So whether it's he's going to have more factories, he's going to increase production from those factories, and then he's going to increase the number of markets. He's not just going to sell here in the USA. He's going to expand, so he's selling in China. So he's selling in Europe. So he's selling in Africa, South America, and Australia. And again, this could be for any company. A small deli isn't going to go sell in Africa, but a small deli might have a store in Port Chester, and then they might open a new store in Greenwich, and they might open a third store in Mamaroneck. And as they grow, they will then become a successful company. All right. Now, companies are supposed to grow. They grow by increasing factories or production or markets. What do they do to grow? What do they need to grow? Well, there's an old saying that goes, it takes money to make money. So they get cash. Now there's 3 ways for a company to get cash. One is they earn it. Like Ford would make a car. He might sell it for $500. It cost him $300 to make it. So he nets $200. He has $200 in profit cash. He's going to use that cash to grow. Another way to grow and to get cash to grow is to go to the bank. All right. And I'm sure Ford did this too. He would go to the bank, he would borrow money from the bank, use that money to build more factories or make his production lines more efficient or expand into new markets. And then all he had to do at the end of the day, at the end of maybe a year or so or whatever it was, is pay back that bank. The third way to do it, and that's what we're going to talk about, what many people did during the 1920s, and actually I even do today, is people went out and they bought shares in these companies. So this piece of paper you'll see right here, this is a stock share, and people went to Ford and he issued them this piece of paper. They gave him $10, and then so he gave them back the rights to a share of the company. And Ford would then, at the end of a year, as long as you still had your stock share, he would share some of his profits with you. And that's the whole sharing part of the share. Ford, the company, shares his profits with you, the investor. What you do is you share your money with him at the beginning. And so during the 1920s, people were buying shares in all kinds of companies, taking their savings, and instead of keeping in the bank or whatever they might do, they took a chance. It's not gambling, but there is some risk, and they invested their money in companies. All right. So if I look here at this slide, for example, you see these three people all own shares of Ford. And what they hope to do is they own the stock or share. It's the same thing. They own them. And then every year, Ford makes a profit and they're going to pay these people back. So people buy shares of stocks, buy shares of companies to make a little bit of money. So going back here, the company makes money. The company has to grow by either earning the money right here in profits, by either borrowing the money from the banks or by getting money from consumers like me and you, who then the consumers get this share in return. All right, so what you're going to do this week is you are going to be given $10,000 to buy shares in 5 firms that existed in the 5 companies that existed in about 1920s. All right, I'm not really giving you $10,000. I'm sorry. What you're going to see this week is this sheet right here that you see in front of you. And you're going to type only in the green boxes, and you're going to type numbers in these green boxes. And the numbers are going to be the number of stocks you want to buy. So here we have RCA, which was an old record company. No longer, I don't even know if it's around anymore, but I don't think you guys have many records in your house. But here you'll see, typing in the green box, the stock price of RCA is $100 for 1 share or 1 stock. I'm going to buy 20. So I type in the number 20, I press enter, and it calculates out. You'll see 100 shares, 20 I purchased, and it automatically calculates $2,000. Now, again, I've given you $10,000 to spend. 10,000. You have $10,000 to spend. You can't spend more than that, and you really should spend less than that either, because you're a smart investor and you're going to maximize your investment. The challenge for you is picking which ones to invest in. You can only pick 5. So let's see, I picked RCA. Looking down the list here, Ford, Kellogg's, Montgomery Ward is like the target of the day. I'm going to buy 27 shares of Montgomery Ward. Looking down here, I have spent so far $2,540. This automatically calculates for you right here. All right. General Motors is the car company. Kinetoscope is like the Netflix of the day. I like watching movies. I'm going to buy 63 shares of Kinetoscope. How much have I spent so far? Looking down here, $4,115. I have a long way to go. Sears and Roebuck is like a Walmart. American Book Company is a book company. Hot dogs. Wright Aeronautical, that's the Wright brothers. They invented the airplanes. I think airplanes have a big future in America. This is 1920. So I'm going to buy 35 shares of Wright. Oh boy, if you'll notice, this just turned red. I bought too many shares. It says right now, if you can barely see it, it says $10,415. I only have $10,000 to spend. So I'm going to change that 35 right here, make it a 25. All right, good. Now this thing is bad. I want this to be yellow. That's good. Now, how many have I bought? 1, 2, 3, 4 companies. I need a fifth one. I like oil, so I'm going to buy Standard Oil. I'm going to buy 25 shares of Standard Oil. And whoops, I went over again. You see, this just turned red. So 25. Now I'm going to play with the number. Maybe I'll buy 20. Still red. Go back here. Maybe I'll buy 15. Still red. I'm over by $265. That's 100, 210, 220, 330. So I'm going to make that a 12 now. Bam, I'm under. I'm over 9,900, which is good. I'm under 10,000, which is good. So now I've made my investments. Your assignment today is to open this spreadsheet, choose 5 companies you want to invest in, and do just what I did. Type in the shares you want in those companies. You can play with the numbers until this bottom number is as close as you can. So, what is a share? A share is a little bit of a company. A share is a commitment from the company to share its profits with you. So, I think RCA, Montgomery Ward, Kinetoscope, Wright Aeronautical, and Standard Oil are all good businesses. They're going to make lots of money in the future, and they're going to share that money with me. That's what I want. So good luck buying your shares today. And as the week goes by, we'll see how the stock market changes to impact the value of our shares. See ya.